Thanks very much, Dr. Panagariya, for being with us. And let me begin by saying it's good to have your views on the Indian economy. Are you someone who believes that 6.3% GDP headline growth is a reversal in the overall trend, or is this just a pause in the downward trend?
No, I do believe that this is now a reversal. The economy bottomed out, therefore, in Q1 of the current fiscal year. Let me, if you allow me a minute or so, just give you my take on what this recovery means. One of the things is that remember that this is a period of restructuring. Therefore, recovering back to 6.3% means a lot more than the kind of things we had seen in 13-14 and 12-13, because that was not a time of restructuring of the economy. So when growing at 6.3% while also restructuring the economy, I think is quite good, quite impressive. That's one part. The second take I have is that as far as I can see in the data that have been put out so far, the recovery really appears to me to be much more private sector led. The real, the government final consumption in this quarter has grown only about 4.1% in real terms, compared to the same quarter last fiscal year, which was 16.5%. So the government the government final consumption had grown much faster in the same quarter last year than it has in this quarter. So also, if you look at manufacturing, the private corporate manufacturing has grown in nominal terms about over 11%. So all these indicators suggest to me that, well, first, the restructuring is very much underway. And second, the recovery is really led by the private sector, which is what I think is very important sign.
I'm glad you're pointing those things out, that the recovery is led by the private sector, and an economy can ill afford if the public sector expenditure just continues. So you're right there. But if you can put it in perspective, sir, the gross fixed capital formation that has picked up pace by 4.7% is actually a slump, because 4.7% of 6.3% growth. How are you going to correlate those figures?
I think you need to correlate the growth rate figure, the GDP growth figure, to the level of additional investment, not the growth in it. So the level of additional investment, which is the proportion of GDP, which is investment, and that is about, I think, if I remember correctly, about 29% in real terms, 29% of the GDP for this quarter. So which is reasonably good. It could be better. We have done much better in the range of about 35% or so when the economy was growing in the mid 2000s at 9% or so. So we need to get back there. But on the other hand, I'm not so pessimistic, because still 29% of the GDP in investment is still quite good. And certainly that investment is very easily able to support a 6.3% growth. In fact, it should be doing a bit more. But our incremental capital to output ratio still remains a bit high, because, in spite of being a very labor abundant economy, our structure still remains very highly capital intensive, with sectors like automobile, petroleum refining, auto parts, two-wheelers, all these, machinery sector, chemical industry. These are all capital intensive sectors, and that has
Right. Okay. There seems to be a trouble with Dr. Arvind Panagariya is freed. We'll try and get back to him. Please try and reconnect with him. But I think it's a very valid point. I mean, some of the things that he's talking about are extremely valid. Can we go across back to Dr. Arvind Panagariya, please? We'll try and reconnect with him. But in the meantime, let's get you Amitabh Kant, who spoke to us right here at ET Now. Can we go across and listen? Okay, I think Dr. Arvind Panagariya is back. And Dr. Panagariya, I want to take this discussion forward and talk to you about two things. First, manufacturing, and I think it's a good rate of growth at 7%. Do you believe that trend can continue, or is it largely on stock of restocking post the GST? So one question on manufacturing, and the other has to be on agriculture. The fact that it continues to be a laggard with growth rates of just 1.7%, how much of a concern is that for someone like you?
Yeah. So on manufacturing, certainly there's some element of restocking. But even if we say that, out of 7%, about 2% was restocking, still 5% growth in manufacturing for now is reasonable because the GDP growth itself is about 6.3%. So on that front, I feel good. It's anybody's guess how we will do going forward. But it certainly is a good start. And as I said, private corporate manufacturing has delivered quite well. So on that front, positive, good. Agriculture, always an issue, because it remains dependent on weather and all sorts of other uncertainties. If you see fluctuations in agriculture over the years, they remain high. So for all those reasons, but again, particularly for agriculture, which remains so subject to fluctuations, we shouldn't go by just quarterly growth rates. So let's hope, for the annual rate, we would do better.
Okay, so let's look at the annual rate as far as agriculture is concerned, but let's talk about the other big elephant in the room, and that's exports. And I know you have a very strong view on exports. Is it perhaps a tragedy that Indian exports haven't been able to pick up when the global growth has rebounded? I mean, look at the way the global growth has picked up, and our exports haven't picked up pace in a similar manner. How big a concern is that, given the fact that yes, growth is picking up, but no country has done well unless exports as an engine of growth begins to rev up?
No, I completely stand by that, and I think that's an area which requires urgent attention. I have been making that point even when I was the vice chairman of the NITI Aayog. That was one of the things that I very much emphasized. There's a number of things we need to do, including, I would dare say, now that I'm not an official, on the exchange rate front. I think, particularly the labor-intensive exports tend to be very sensitive to the exchange rate because their margins tend to be very small. So any, small shifts in the costs make a difference for garment industry, for example, footwear. These are the kinds of exports very sensitive to the exchange rate and other changes in the cost. So I think we really need to focus on that front in a big way. Things have improved some, but quite a ways to go.
So I'm going to now shift focus and talk about the fiscal space. Obviously government spending will slow down because most of it was front loaded during this fiscal, and we will perhaps see the government spend a lot less in the third and the fourth quarter. Already it has softened. The question really is, as government spending comes down, obviously to keep its fiscal deficit intact, what sort of a ramification do you believe this can have on the overall investment environment?
The good news, I like to see the glass half full rather than half empty. And the good news I see is that private sector is picking up. I certainly think that the government ought to stay its course on fiscal consolidation. And what that, of course, would mean is that you are leaving more funds to be borrowed by the private sector. And insofar as, the private sector tends to be a bit more efficient at using funds, if the government really stays course, then we have the private investment pick up. We have also seen some, action on the banking side. The State Bank of India has raised the deposit rate by 1%, which means that the funds for the banks are beginning to tighten up. The excess liquidity is going away, which also seems to suggest to me that actually we have that the investment borrowing by the corporates has not picked up in a bigger way.
Indeed, and it's always good to look at the glass half full rather than half empty. But the other headwind that one would want to talk to you about is crude oil. I mean, there is no denying that this government has been a big beneficiary of a benign crude oil regime, but that dynamic is beginning to change. In the last 3 to 4 months alone, crude has picked up by what, 23 to 24%. can we be sanguine about it anymore? Because yes, crude may not completely derail our economy, but it does squeeze the elbow room for a lot of spending, for a lot of fiscal, fiscal investments that the government could do. So in some sense, is crude, both for the fiscal and the current account deficit, how big a concern is rising crude oil price for you?
Yeah. So one on the current account deficit side, I worry a bit less because in a way our exchange rate ought to respond to the tendencies towards larger imports through depreciation. So less worried on that. On the fiscal front, again, my own understanding of this government is that this government is very committed. It has invested an awful lot in the last 3.5 years in achieving fiscal consolidation. So I personally, at this point, have zero doubt that the government will stick to its consolidation plan. Now, that does mean that the government's own expenditures might take a different form in any case. But once again, I'm not so pessimistic about the oil price itself because the oil prices, with the shale and other alternative supply sources, the oil prices cannot stay very high for very long. And you had played this interview, I think, from the CEA, Arvind Subramaniam, at the beginning of the show, and he was arguing that, look, the price is showing some signs of softening already.
No, indeed, it is showing some signs of softening, and we do hope crude stays benign for the larger good of our economy. But before I let you go, two quick final questions, and one of them has to be another headwind that some people are talking about, which is the new IBC norms, the new Insolvency and Bankruptcy Code. And we had some experts on the channel who believe that, given the norms and given the stringent criteria, many companies will end up in liquidation, and that will, in turn lead to a lot of asset value erosion, a lot of asset value destruction, which will have ramifications for the economy at large. Do you agree to that viewpoint at all? Do you share that concern?
So I'm not an expert on it, but my take really on this, Supriya, is that I think the Prime Minister is committed to the cleansing, and if he were not to do that, I think we will all go in and complain that, look, people who cheated the taxpayer and cheated the banks and so forth are now being allowed to go scot-free. So I mean, we are in a situation, you're damned if you do, damned if you don't do. But my personal take is that some credibility needs to be established, and the Prime Minister is certainly trying to do that, do his best on that front. That, look, the days when the banks could be cheated in this way, the days when the system could be manipulated are now over. And those who have not played it by the book will be brought to the book. So I sort of, even if it does mean a bit of asset erosion or asset value erosion, I think for the greater good, for the longer term good, this is a kind of cleansing time for it has come.
All right. A final question to you. In fact, I cannot not ask you about the RBI, and you can't not give me an answer, because as NITI Aayog Vice Chairman, you often said, I will not comment on the central bank, but you can't escape that question now. What do these numbers really do as far as the central bank is concerned? What do these numbers do as far as the RBI's monetary management is concerned? Do you believe, given the inflation focus, they will continue to focus on inflation, which is on its way up, and there should be no scope for monetary easing? That's one question. And the other question on RBI also has to be that some people have said that the rupee is perhaps a little too strong for comfort. Should the RBI perhaps intervene a little more?
On the exchange rate, indirectly, I've already said to you, so I would like to see actually rupee depreciate a bit. It still in real terms remains a bit overvalued. And for the sake of labor-intensive exports, I particularly feel that we need the rupee to soften a little bit. On the interest rate, I think, at this point, whether they should come down or not has become a little bit more of a question. But in the longer run, I think we do need the interest rates to come down. I mean, I'd rather connect it, to this whole issue of inflation targeting. That I've always felt that 4% inflation target that we have set actually is a little too low. Because what happens is often the central banks tend to be conservative. So if the target is 4%, they start targeting 3%. And for a developing country, getting 4% or 5% of inflation actually is a healthy thing. That at least is my understanding of development economics. And so therefore, if we were to actually then tinker back a little bit with the target itself, move it from 4% to 5%, it will give the RBI also a little more headroom. Because you see, when the target itself is so low, 4%, then the RBI says that, look, law commits me to staying with 4% inflation. And I have to ensure that it is 4%. And so therefore, I think the RBI's task itself in terms of loosening the interest rate becomes more difficult. So I would personally actually pitch for, let's raise the inflation target from 4% to 5%.
You really want to reset the inflation targeting regime altogether. But one final question. At 6.3 for second quarter, 5.7 for the first quarter, things hopefully will look up from here on. Where should India be ending financial year 18 as far as that big growth number is concerned?
I suspect that 7% would be a little ambitious now. So we'll be a bit slightly below 7%, maybe 6.8 or so. Because to get to 7, we'll need, because we are at 6 right now, to get to 7, it will require second half would be 8%. That's a bit ambitious at this stage. So I would say a little below 7 is where we are going to end up.
All right, Dr. Arvind Panagariya, always a pleasure chatting with you and getting your perspective as far as the Indian economy and the macros are concerned. We do hope they're on the mend, and we continue to hope that we will keep having conversations like these with you, insightful conversations indeed. Thanks very much for being with us on India Tonight.